Welcome to Investors Guide. You're watching ET Now. I'm Faye. This is such a special episode for me. Investors Guide this week turns 6 years old. We're over 300 episodes old. For the last 300 weeks, I've been here week on week, holding your hand as we've been through this journey together. I'd like to thank you, first of all, for your support and tell you what a special show I have planned for you this week. In our continued endeavor to help you understand your investments and become rich over the long term, I have with me this week India's maestro of wealth creation, Raamdeo Agrawal. Now, Raamdeo came to Mumbai in 1987 and started a brokerage firm, and today a massive building is testimony to the success of that sort of wealth creation. Raamdeo is today going to share his secret with all of us as retail investors, so it's really special for us. Raamdeo, thank you so much for spending time with us this week. I mean, it stands to reason, obviously, that the success is largely equity-based and linked to the equity markets, although a lot of retail investors worry that if they put money in the equity market, they might lose over the long term. And when I, announced on Twitter that I'm going to be meeting you in person, one of the viewers wrote in saying, it might have been a great time 20 years ago to invest in the stock market. Maybe 10 years ago was also a good time. But how do we know that today is a good time as well? So what's your answer to that? To investors who are asking, yes, historically it was fantastic, but how do you know that today is a good time to enter?
So, very good question. Actually, it makes me thinking that in last, this is what, 35, 37, 38 years of the market history, recorded by the indices. Sensex started in 78, 7900, 7900. So that's about 36 years. So in 36 years, markets have gone 270 times. Ex-dividend. If you do it come dividend, it's almost like 500 times. 1.5% dividend you do, it's about 500 times. This is just the dumb index we are talking about. People have made multiple times more money than this thing. So, what is stock market? It's not about the history or anything like that. It's about what the companies do. What are you buying is the businesses. Are you saying the businesses made money in last 20 years and now there is a profit holiday? We have seen nothing of the businesses. Much bigger scale of, in last 10 years, Reliance has gone 10x. So I think future is bright. You have to be very optimist, and the fact is that GDP is growing every day. So in next 10 years, the country will be much bigger, the world will be much bigger, country will be much bigger, a lot of business will be much bigger, and they'll make a lot more money. The issue is, what are the companies you buy in your portfolio? You have to buy the companies which are going to make a lot of money, and then nobody can stop you from making a lot of money. It's that simple.
I want to take you back a step, and for those of our viewers who don't know this, and we ran the numbers after reading your book, 17% annualized over 30 years. At the end, I'll have 100 times what I invested in the beginning, the 100x magic number. Now, standing where we are today, again, a lot of investors will say, no, but real estate has done so well, gold has done so well, there are other asset classes to consider. If I want that 17% year on year for the next 30 years on an average, is equity the only asset class that will give it to me? Is equity the best asset class that I should look at?
Yeah, it's not the only and the best. It is the only asset class I know, at least. Okay, but I think real estate could be another one, which could be of the same type. Or if you run good farms, if you're running agriculture on your own farms and you do some exotic stuff, clearly you can make that kind of money. But for a very large variety of people with a lot of money, stock market is the biggest game in town, because stock market represents the ownership of all the businesses, all the large organized businesses in the country. So nothing can be bigger than that. So stock market is a big place, and here you can make not only 17%, you can make 30% compounded, you can make 40% compounded. Like Mr. Buffett has made more like 21% compounded for last 50 years. See, 30% compounded for 20 years is one thing, but making 20% compounded for 50 years is a completely different thing. If he goes at about 15-20% for another 5-7 years, which he'll be the first trillionaire. Starting from big zero to $1 trillion in one lifetime. That's the story of a stock market.
If I'm going to tomorrow enter the stock market and try and find those few stocks that will actually, hold me in good stead over the next 30 years, how do I find those stocks?
See, like in the stock market, what has happened is, unlike in gold and real estate market, here there are 5,000 companies. There are only 1,000 companies, in my view, are worth investable. 4,000 companies are bad to very bad. Okay, they must not enter your portfolio. Now, so first job of the investor
is to be able to tell
is
the difference.
to figure out that one company out of 5.
Okay.
Okay, so that's a 80% job done, I am telling you.
Okay.
Now, within that 1,000 also, since they are good, they are also very well priced. So, how do you figure out difference between a very good company and good company? Then, which is going to grow, which is not going to grow? Then third is at what price I am buying. Finally, at what price I am buying. So, to understand the value mindset, see, having the vision that this thing is going to become very big is the first starting point.
Yes.
You need to have the vision.
Yes.
And courage to buy. But when you buy, when you go to buy, you should have that value mindset to understand how much this company is worth. Today, if price is there everywhere, but what is the underlying value? So if TCS is trading at 5 lakh crores, whether it is worth 10 lakh crore or is in next 5 years it is going to become 10 lakh crores. If it is not, in that case, if you buy at 5 lakh crores, you might lose money.
Yes.
So this is a fantastic company, but still you might lose or you might make a lot of money. So the value mindset, understanding what is going to happen in the future, because what you are buying is the future of the company. You are not buying the past. Past is just a product. So to have that vision, to see the future of that company and future of the value in that company, you are not concerned about how many jobs. You are concerned about how much value it will create.
Well, I'm going to, very quickly ask you, we are in a market right now where a lot of the really large companies, the names that as retail investors we're familiar with, so I know what an Infosys is, I know what an HUL is, I know these large names. Those companies seem to have corrected a bit, they're available at slightly lower, cheaper rates. Is this a good time to go out and pick up those names that we know of?
Yeah, but to say that a company is a very dangerous thing, particularly in this kind of interview. To say this company is good, bad or overvalued and all. But this is a great time to buy good portfolios.
Yes.
So-called mutual funds or PMS or whatever. Because when you buy 15, 17 companies, a set of 15, 17 companies, all companies being good, small, 100 of them, what happens is, you will always be wrong. To some extent you will be wrong in picking the stocks.
Yes.
Even the portfolio manager will also be wrong. Howsoever good he is, out of 15 companies, 3 or 4 will not work as per his expectation. Probably it will disappoint him. 1/3 typically will be as per his expectation, but 1/3 will surpass his imagination. So this, what surpasses, will more than make up for the disappointment, because the loss can be only 1x. Please understand this. This is the biggest thing why you should come to the stock market and come for the quality and long term. When you are buying long term and quality, and you are wrong, you can lose only 1x.
Okay.
Out of 150 bucks, 15 stocks you bought, 10 rupees each, 5 are wrong, you can lose only 50 bucks. But the 50 bucks where you are more than right, you can make 10 times, 100 times. Infosys incident is 6,000 times. So there is no limit to how big can you become. Upside. Downside is limited. You can only lose 100%. So, this portfolio approach and where this protection is there is limited and upside is unlimited. You need to see that the person who is managing your portfolio, he has a skill to buy 1/3 bad stocks and 2/3 good stocks.
In fact, on that thought, you had said something else some time ago, which I thought was beautiful. You said, in order to be able to to find that 100x stock and hold it, it's not just about finding it.
Yes.
You have to have the vision to see the future of that stock, the courage and the faith to actually buy it, and the patience to hold on.
Hold it,
Give me an example that, we can relate to, where you saw a stock actually, see through that journey, where you've actually taken a stock through that journey.
Yeah, so actually, as you said, vision to see, courage to buy, and patience to hold. In fact, out of this study, 100x study, the only thing I learned is that I need more patience than whatever I have shown so far.
Even more than you have?
Yes.
Okay.
So, say Hero Honda. That is one stock which I bought and still holding. So in 96 or 90, I think it was 96, 95, 96, when the bike was coming in, the fuel efficient bikes were coming, 4-stroke bike was coming. So scooter was rage, like Bajaj scooters used to sell. So from the scooter market, the market was moving to
the bike
motorcycle market. The young generation was just picking up. So at that point of time, these Hero Honda bikes were so fuel efficient that they were in short supply. They were 2,000-3,000 rupees premium, and they couldn't produce enough. And the stock, I don't know how it was available at that price. So stock was available at about 12, 13 P. For 1,000 crores, you could buy entire Hero Honda for 1,000 crores. And 12, 15 P multiple, they were 2-3% dividend yield. It was growing at 30-40%. So I found it very funny. I said, this company with a Hero plus Honda, the world's biggest company and the best manager here in Hero, they are going to clean the whole market. And that's what really happened. And in next, now it is a 52,000 crores. But more important is how much dividend they've given. I bought actually for 30 rupees. Today they give 60, 70, 100 rupees dividend every year. For that 30 rupees, they have already given, I think, 1,200, 1,300 rupees dividend. And you can sell that 30 rupees stock for 2,500 and it's still counting. So I think what is important is to understand high quality business. In fact, the game is buy high quality business run by high quality management. 10x business multiplied by 10x management.
You know, in your book, you also mentioned consumer-facing stocks, which is also easy for me as a retail investor because I can look around my life and pick out brands that are familiar. The tea brand that I use, or you know, if I'm a gentleman watching, whatever razor brand I use, these are all stocks available. Is there a particular reason why you believe consumer-facing stocks will do better? Is that the reason, or is it because I'm familiar with the kind of business, I understand the business, I know how it works?
It is very difficult to buy the consumer loyalty. And once you have got millions and millions of them as your loyal consumer, for other guy to enter, that becomes the biggest entry barrier. So what happens is that there is a large opportunity, say Maggi noodle. Now noodle is a big opportunity. It was not there. I mean, say in 70s and 80s, nobody used to eat masala noodle. At least I was not knowing what is it. And suddenly, I mean, in last 20 years, they made it almost 250,000 ton capacity. I mean, it's a 3,000 crores brand. It is one of the largest, probably the largest single brand food product and growing at 10, 15, 20%. So sky's the limit. So, you know, that kind of consumer loyalty for a product. And there are so many noodle products.
So, so here's the question then of patience, because you know you mentioned Nestle in your book as well as one of those stocks that you studied. So you saw the future of the company, had the courage to buy it, and now when Maggi is in the kind of trouble that it is in the country, is this the kind of time where you have to have patience with the stock and say, no, I believe in the valuation?
Patience and aggression to buy more.
Really?
Yes.
Buy more Maggi at
I'm
this
just
point? Buy more
for
Nestle at this point?
Yes.
Okay.
At a right price, I'll buy double.
So you're not worried at all?
Not at all. The reputation of Nestle worldwide is at least 100 times more than Government of India itself. Nestle bonds in Europe trades at negative yield. Government of India bonds trade at 7-8% yield. That's the kind of a reputational gap. I mean, today Nestle is in trouble. Today it is making, say, they make about, They make about, say, 1,000 crores. Okay, last year they made 1,000 crores profit.
Yes.
10 years henceforth, will it make 5,000 crores profit or they will make 500 crores profit? That's the question to be answered. If the answer to your conviction is that 500 crores profit after 10 years, obviously this is not the stock to be in. But if they are going to make 5,000 crores profit in 10 years time, 10th year, then what should you do? You should welcome the downturn in the stock so that you can load up enough.
All right, so this is the time to load up on good quality, solid companies.
See, there is always a time to buy quality stocks. See, you must know at what price you are buying. You know, so in bad market, if stock is very expensive, then you should not buy. But if in a very good market, stock is available cheap, then also you should buy.
All right, so we're going to have to take a very quick break now, but when we come back, if you find all of this even still too complicated, there are mutual funds to consider. And we'll talk about Raamdeo's own mutual funds on the other side. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. This is our very special 300th episode of the show. Raamdeo Agrawal is with us. Raamdeo, before we went into the break, we were talking about picking specific stocks, and you did mention that you said the portfolio format really works the best. It doesn't make sense for me to buy one stock and then hold on to it and pin all my hopes onto one company. So again, from my point of view, the easiest way to do that is through a mutual fund. And you have mutual funds as well in the market, and what I think is most interesting is that you've invested some of your personal money in those mutual funds as well, because you're proving a point here. Explain to us why you did that.
Yeah, so I've been picking stocks from 1980. Okay, now, so built our portfolio, and it has done very well, and I made a lot of money. That Hero Honda and all we did personally. Then, as the company, we set up this Motilal Oswal AMC, and we launched the products. Then I realized that whether to take care of these products or take care of my portfolio. So some energy was going there, and then you have the conflict also. SEBI guidelines are there, what you can buy, where, when. I said, damn thing, I mean, if you want to build the AMC, let me first clear the conflict itself. So Motilal and I said, let's dump everything in here. So we sold methodically, and still something is left. But we sold everything and bought into this. So my 100% of net worth is in my own mutual funds.
It's in your own mutual funds.
Yeah.
Now, as the manufacturer of mutual funds, if any manufacturer of any product normally gives instructions with that product, and say dry clean this shirt, don't put it in the washing machine. So if I'm going to access your product that you have manufactured, what instructions will you give me as your customer? How should I use that product?
So one is that buy only for long term.
Define long term.
Yeah, long term means if you are expecting significant return in 1 year, I would say that don't come here. Go to some debt products or go to even fixed deposit, because you have some payments coming. If somebody's marriage is there or some tuition is there, and you need definitely X amount of money after 12 months, I would say that go for the fixed income. You are sure to get it, and you'll get 5-10% higher. So that's how it is. Anything less than 2 years, the advice will be like that. But beyond 2 years, I would think that you can invest to the extent you are comfortable. You can invest here, and longer the better. The time to invest is when you have the money, and time to disinvest is when you need the money. That's the kind of thing. It is almost like an OD format. Whenever you access money, you can park it here. It's a no-load fund, and since you will be accessing directly, it's a very low cost. And I mean, you pay, if you are there for 300 days, you pay for only 300 days, whatever 1% fee. I think for 1% or 1.5% fees, I think it's a terrific deal. And tax protected. In mutual fund, you have all, whatever I do, say if I do short-term profit for you, still you don't have to pay any tax. And when you take it out, and it is more than 1 year holding, your capital gain, you are protected from the long-term capital gains tax. And I think all the dividends declared by me will also be tax-free. So I think Government of India has done whatever it could do to see that you come into the mutual fund format. And I am also in the same format. So one is that your incentive, your well-being is linked to my well-being. You can jump the ship if I don't do well, but I can't jump the ship. Okay, so I am tied to end of the thing show. Now the issue is that the philosophy this fund follows. What is important is what we have written in our book, QGLP. It's 100% being practiced there. Quality, growth, longevity. That's the way, that's the dharma. That's the investment philosophy. It has delivered in the past. There is no reason, and we are better, let me tell you. What will happen in the future, that nobody knows. But I'm a much better driver. Our F1 Ferrari has been working very well for last 10-12 years. And I have trained, I have got now 1,000 hours on my back. I should drive better. But what will be the result, only time will tell.
We talked about the role of the investor and the role of the manufacturer when it comes to mutual funds. There's a third person in between, which is the intermediary. And so much has been said about whether the intermediary has done a service or a disservice over the last 6 years, or the kind of advice that has been given out. Let's look at it backwards a little bit. If I am an investor right now and there's someone sitting in front of me telling me that this is what you should do, what should be my expectations from that intermediary? What should I expect from him? What should he ideally be giving me as a service? And how can I tell whether he's there in my interest or in his own?
I mean, the best way is to have intermediary whose conflict about the so-called you or me is not there, because you can't leave it open. Give him the fee. Nobody wants to pay the fee to the intermediary. So then all the trouble starts. Give him whatever 0.5%, 1% you want to give. Say 10 crore you want to manage, give him 5 lakhs, 10 lakhs, whatever you agree on to. After that, he must deliver you, then you have bought his loyalty. And then he is supposed to give you the best possible options in various categories. Because then he is not going to make any money on the product what you are going to buy from him. So that's the way to. So first is remove the conflicts and compensate the intermediary for his services by way of fees, which none of the clients are doing, and they keep blaming the intermediary. So that's not fair. So because he is also running a P&L for his own, and that conflict has to be resolved before the client expects a so-called very free and fair service from intermediary.
Would it be fair to say if I've just met with an agent or an intermediary or an advisor and I'm happy with his service, I should actually ask myself, what does it cost this person to meet me 3-4 times before I make my decision, to have my forms filled and all of that, and then decide that, okay, this is how much I think I should pay him. What is the ideal way to arrive at that decision? Because you will not believe how many times investors ask us this question. What should I pay my advisor?
It's a some amount of fee. Say you have a crore, so the client, the intermediary himself will say, I will charge 1% of this thing corpus for managing it, and these are the services I'll give, or I'll charge 50 bips. I mean, then it's a matter of negotiation.
Rather, in all fairness, the people who watch this show invest an average of 10,000 rupees or 20,000 rupees or 30,000 rupees a month.
Then, so those kind of people, they have to basically rely on their own instinct. Very high quality intermediary. I mean, whatever local brokers and all, they will be available to you. They are very good guys, but because your corpus is very small, you will get only that much advice. So you have to be taking care of yourself when you are a small investor, honestly, and go for a very commonsensical general products, say like SIP or a very well-known fund. I mean, if you can figure out you don't have to buy the best fund.
Keep it simple.
Keep it simple as possible, and you will probably do a better job. It will definitely do a better job. Don't complicate the situation.
There's a similar question that comes up with both stocks and mutual funds, which is how many is too many? A lot of times people have a lot of stocks in their portfolio, sometimes upwards of 50 stocks in their portfolio. A lot of times people have, and I know this for sure, upwards of 25 mutual funds in their portfolio. How many is too many?
Yeah, no. I think as far as the stocks are concerned, we don't do more than 20. We do anywhere between 17, 18, very focused. The schemes are called F25, F30, F35. But those are the permissions we have taken from SEBI. But actually in the portfolio, you will not find more than 7, definitely less than 20, 17, 18, 19, 20, those kind of things. So we cannot manage too many babies. So it's like that.
We've run out of time on this interview, but I want you to give one piece of advice from your personal learning for anybody who's watching, who's starting with his first 100 rupees or his first 1,000 rupees or his first 1 lakh rupees and hopes to someday be the next Raamdeo Agrawal. What is the advice you'd give to people who are watching?
Next Raamdeo Agrawal has different connotations, but see, you have to be passionate about what you do. Even for investing, you have to be very passionate. Stock picking, you have to be passionate. Then all the routes will open, I'm telling you. You will find your way. You wanted to become an anchor, you found a way. It's not that easy a job to get. So you have to be passionate about what you want to do. You will make it, I'm quite sure.
Alright, so passion is the chief ingredient.
Yeah, that's the first starting point.
Alright, for those of you watching at home, there is a book out in bookstores right now. It's called The Art of Wealth Creation by Raamdeo Agrawal. It's possibly available in the bookstore closest to you, although I got my copy online. If you're an enthusiast of investing and of stocks, it's a wonderful read and you must get your hands of it. 19 years worth of research is in this book. Raamdeo, thank you so much. I wish you all the best and I thank you for your time and your advice.
No, we wish all the best to the investors for making a lot of money in the future.
Thank you so much.
Thanks.